You're scrolling through Reddit at 2 a.m. looking at screenshots of portfolio gains. Someone just turned $5,000 into $47,000 on a single options play. Your coworker won't shut up about the AI stock they bought that's up 300%. Meanwhile, you're sitting there with a diversified index fund that's up a boring 9% this year, wondering if you're the only person in America who doesn't know some secret money cheat code. My name is Mr. AI Invests, and I've spent years watching people destroy their financial futures while thinking they're building them. The flashy investor trap isn't about making bad investments. It's about confusing performance with progress, and the difference will cost you everything. Here's what's happening. You open your brokerage app, your boring S&P 500 index fund is up 11% year to date. That's objectively good. That's above historical average, but it feels like failure. Because your college roommate just posted on Instagram about how their cryptocurrency portfolio is up 180% this month. Your neighbor casually mentioned at a barbecue that they made $30,000 day trading Tesla options. Some kid on TikTok is showing off a $250,000 gain on meme stocks. And you're sitting there with your index fund feeling like the financial equivalent of showing up to a Formula One race on a bicycle. Here's the number that should terrify you. Approximately 90% of day traders lose money over any 12-month period. 90%. That's not a strategy. That's a casino where the house always wins. But here's what nobody tells you. The 10% who win, they're not posting their losses. They're not showing you the 3 previous trades that wiped them out. They're showing you the highlight reel. And you're comparing your entire reality to someone else's carefully curated fiction. The financial services industry loves this arrangement because confused investors generate more trading fees, more platform engagement, more revenue. Nobody in that system makes money when you buy an index fund and ignore it for 30 years.
Now, if you're sitting there thinking, well, Mr. AI Invests, I'm not stupid enough to day trade, I just want to pick a few winning stocks. I hear you. That sounds reasonable. That sounds like what smart investors do. But here's what you're actually doing. You're competing against algorithms that can process 10,000 financial statements per second. You're competing against analysts who spend 80 hours a week researching a single sector. You're competing against insider information you'll never have access to. Imagine you decided to become a professional basketball player, but instead of practicing or developing skills, you just show up to an NBA game and try to take the ball from LeBron James. That's not confidence, that's delusion. That's what individual stock picking is for 99% of retail investors. Let me show you the math. The average actively managed fund, run by professionals with research teams and Bloomberg terminals and direct CEO access, underperforms the S&P 500 about 85% of the time over 15-year periods. These are people who do this for a living, with massive resources, and they can't beat the market. But somehow you think you can do it from your phone while sitting on the toilet between meetings. Here's how the flashy investor trap actually works. It exploits 3 psychological vulnerabilities that are hardwired into your brain. Vulnerability number 1, recency bias. Whatever happened most recently feels more important than long-term data. Someone posts a 200% gain yesterday, and suddenly the historical 10% annual return of the stock market feels like a scam. Vulnerability number 2, survivorship bias. You only see the winners. For every person posting screenshots of massive crypto gains, there are 50 people who lost everything and deleted the app in shame. But they're not posting. They're not visible. So your brain thinks winning is more common than it actually is. Vulnerability number 3, social comparison. Humans are wired to measure success relative to their peer group. If your peers are posting investment wins, your boring index fund feels like failure even when it's objectively performing well. Now add social media into this equation. Instagram, TikTok, Reddit, Wall Street Bets. These platforms algorithmically promote the most extreme content. The boring success stories don't get engagement. The $1 million options play gets 50,000 upvotes and national media coverage. So you're consuming a completely distorted representation of what investing actually looks like. It's like if the only news coverage of aviation was plane crashes. You'd think flying was a death sentence even though it's statistically the safest form of travel. Let's run a scenario. You've got $50,000 saved up. You see someone on Reddit turn $10,000 into $100,000 trading options over 6 months. You think, I could do that. You take $10,000 and start trading. Month 1, you make $2,000. You feel like a genius. Month 2, you lose $3,500. Month 3, you're down another $4,000. By month 6, your $10,000 is worth $3,800. Meanwhile, if you just put that $10,000 in an S&P 500 index fund, you'd have around $10,700, assuming typical 7% annualized returns. Not exciting, but not destroyed. Over 30 years, that boring $10,000 index fund investment compounds to approximately $76,000. The money you lost chasing flashy trades, it's just gone. That's $72,000 in foregone wealth because you wanted to feel like a genius instead of actually building wealth. Meet Marcus, 32 years old, software engineer making $120,000 a year. Has about $80,000 saved up across retirement accounts and taxable investments. Pretty solid financial foundation. Month 1, Marcus sees a YouTuber talking about how AI stocks are the next internet gold rush. He takes $15,000 from his emergency fund and buys shares in 3 small AI companies he saw mentioned on Twitter. Stock picks feel smarter than index funds. Month 2, one of his AI stocks jumps 40% in 2 weeks. Marcus feels vindicated. He posts about it on LinkedIn. Friends comment asking for tips. He feels like he's finally figured out what wealthy people know. Month 4, 2 of his 3 AI stocks have dropped 25% and 30% respectively. The one winner is now only up 15% from where he bought it. He's down about $4,000, but he's convinced this is temporary. AI is the future, he tells himself.
Month 6, Marcus sees crypto influencers talking about an altcoin that's about to explode. He takes another $10,000 and buys in. The coin pumps 60% in 3 days. He's euphoric. He should sell. He doesn't. The coin crashes back down 80% the following week. Month 9, Marcus is now down about $18,000 from his original portfolio. He's got $15,000 in AI stocks that are underwater. He's got $2,000 left from a crypto position that was briefly worth $16,000. His emergency fund is depleted. His credit card has a $5,000 balance from covering expenses he couldn't afford after burning through savings. Month 12, his car needs a $3,000 repair. He doesn't have the cash. He finances it at 18% APR. He's now paying interest on a depreciating asset because he chased internet stock tips instead of maintaining basic financial stability. Meanwhile, his coworker Sarah put $25,000 into a boring target date retirement fund the same year Marcus started stock picking. She never looked at it, never traded, never stressed. Her account is worth about $27,500. Nothing spectacular, but she's not in debt. Her emergency fund is intact. She's sleeping fine. This is what the flashy investor trap looks like in real life. It's not dramatic, it's not a single catastrophic loss, it's a slow erosion of wealth through 1,000 small decisions made to feel smart rather than to build actual financial security. We've normalized financial gambling and rebranded it as investing. Scroll through FinTwit or Wall Street Bets or any investing community online. The language isn't about building wealth, it's about printing money, getting rich quick, 10x gains, going to the moon. That's not investing terminology. That's lottery ticket psychology dressed up in a business suit. We've created an entire culture where boring, consistent wealth building is seen as failure, where admitting you own index funds gets you mocked as unsophisticated, where financial prudence is confused with cowardice. The financial services industry has done an incredible job convincing people that complexity equals sophistication. They don't make money when you buy an index fund and hold it for 30 years. They make money when you trade frequently, when you buy complicated products, when you chase performance and generate fees. Robinhood sends you push notifications when stocks move. They use confetti animations when you make trades. They've gamified investing the same way casinos gamify slot machines. This isn't designed to make you wealthy. It's designed to make you active, because activity generates revenue. Social media amplified this to an absurd degree. The algorithm doesn't promote the guy who contributed to his 401k and logged off. The algorithm promotes the 22-year-old who turned $1,000 into $100,000 on GameStop options. Never mind that he lost it all 3 months later. That part doesn't get the views. So you're consuming a steady diet of financial pornography. Unrealistic outcomes, cherry-picked success stories, survivorship bias on steroids, and your brain is comparing your regular, normal, healthy financial trajectory to these statistical anomalies and feeling inadequate. That's not personal failure, that's algorithmic manipulation of your psychology for engagement metrics. Here's what's actually happening at the systemic level. The entire apparatus is designed to make you feel like passive investing is for losers, while active trading is for winners, because passive investing is terrible for everyone except you. Brokerages make money on trades, not on you holding assets. Financial media makes money on clicks, not on telling you to be patient. Influencers make money on engagement, not on promoting boring strategies that work. So the economic incentives of everyone in the financial content ecosystem point toward the same thing: convince you that you need to be active, that you need to pick stocks, that you need to chase performance. Meanwhile, the actual data is devastatingly clear. According to multiple studies, over 90% of actively managed funds underperform passive index funds over 15-year periods. That's professionals with teams, and they can't win. The average investor underperforms even those actively managed funds because they buy high and sell low based on emotion. They chase last year's winners. They panic during crashes. They trade too frequently. The median stock holding period for individual investors is now less than 10 months. That's not investing. That's speculation with a different label. Future you, sitting in retirement trying to figure out how to make Social Security cover your expenses, is watching you right now from 30 years in the future, wondering why you traded away your financial security trying to impress strangers on the internet.
So here's what you actually do instead. Step 1. Accept that boring wins. The S&P 500 has returned about 10% annually over the past century. Not every year. Some years it's up 30%, some years it's down 20%, but over long periods, it compounds into generational wealth. You don't need to beat that. You need to match it. Step 2. Automate everything. Set up automatic contributions to a target date fund or a simple 3-fund portfolio. Low-cost index funds, total stock market, total international, total bond market. Done. You're diversified globally across thousands of companies for almost zero fees. Step 3. Ignore the noise. Delete the stock-picking apps. Leave the investing subreddits. Unfollow the crypto influencers. Check your portfolio once per quarter. Rebalance once per year. That's it. If you're making $60,000 a year and contributing 15% to retirement accounts, that's $9,000 annually. Over 30 years, with a conservative 7% average return, that's over $850,000. If you bump your income to $80,000 and keep the same percentage, you're looking at well over $1 million. Not through stock picking, not through crypto gambling, not through day trading, through the most boring, unsexy, un-Instagram-worthy strategy imaginable: consistent contributions to diversified, low-cost index funds over multiple decades. The first $100,000 takes about 7 to 10 years for most people. It feels impossible, but once you hit that threshold, compound interest starts doing the heavy lifting. Your money makes money. The second $100,000 comes faster. By the time you hit $500,000, your investments are generating more annual growth than you're contributing. This is the actual path.
It's not exciting, you won't have screenshots to post, nobody will think you're a genius, but you'll be wealthy. Actually wealthy. Not internet performative screenshot wealthy. Wealthy, wealthy. You can choose not to do this. You can keep chasing the flashy plays. You can keep trying to beat the market. You can keep scrolling through Wall Street bets at midnight looking for the next GameStop. And maybe you'll get lucky. Maybe you'll be in that 10% who actually wins. Or you can acknowledge that the game is rigged, that the house always wins, that individual stock picking is a sucker's bet designed to generate fees for brokerages and content for influencers. The people who actually build generational wealth? They're the ones who figured out that nobody's keeping score except them. They stopped caring about posting portfolio screenshots. They stopped trying to impress people who don't actually care about their financial future. They got comfortable looking boring while building something substantial underneath. They maxed out their 401k, they automated their investments, they lived below their means, they ignored the noise. That's real wealth. Not the screenshot, not the viral tweet about your options play. Real wealth is waking up at 50 years old and realizing you don't need your job anymore because your portfolio could sustain your lifestyle indefinitely. The flashy investor trap promises you'll feel like a genius today. The boring investor path promises you'll actually be wealthy tomorrow. Most people choose the feeling. That's why most people are broke. Don't be most people. Invest boring, build quietly, automate everything, and I'll see you in 30 years when you're actually wealthy instead of just performing wealth for strangers on the internet. If this perspective helped you avoid a six-figure mistake, hit that subscribe button. I'm breaking down the financial traps that keep Americans broke every single week. And unlike the influencers selling you courses, I'm just showing you the math. Subscribe if you want more of this. I'll see you in the next one tomorrow.